Gold was confiscated in 1933. Silver was nationalized under the 1934 Silver Act. Today, silver supply is tight, industrial demand is rising, and China is tightening exports. What conditions would have to exist for gold and silver ownership to be restricted again today? This is a structural macro breakdown, not hype. Let's begin. Something feels tight, not loud, not explosive, just tight. You see it in whispers around March delivery stress. You see it in the questions nobody wants to answer directly. Are the ounces there? Because futures contracts are promises. Delivery is reality. And every March, every major delivery month, the same question quietly builds tension. Open interest, registered stocks, eligible versus available. Paper claims versus warehouse bars. What happens if too many people ask for the metal at once? Not a default, not officially, just delays, cash settlement incentives, orderly markets. But what if it's not orderly? And now layer on silver. Silver is not just money. It's circuitry, it's solar, it's EVs, it's defense electronics, it's missile guidance, it's AI hardware. Unlike gold, silver disappears. Industrial demand consumes it. You don't melt down solar panels and refine them for coins. You don't recover silver from every chip economically. So the question becomes, if global above-ground investable silver is tight and industrial demand is inelastic and inventories are declining, what breaks first? Is it price? Is it volatility? Or is it the rules? Then look east. China tightens export laws, not loudly, not dramatically, just incrementally licensing requirements, strategic review, national security framing, rare earths, gallium, germanium. What happens if silver becomes strategically sensitive? If the world fragments further, if export controls widen, if industrial metals become geopolitical leverage, at what point does silver stop being a precious metal and start being a strategic material? Because once it becomes strategic, it becomes political. So let's zoom out. We've seen this movie before. In 1933, during the Great Depression, gold ownership became illegal for Americans under Executive Order 6102, signed by Franklin Delano Roosevelt. But why? Was it greed? Was it control? No. As always, it was math. The dollar was redeemable in gold. Banks were collapsing. People were withdrawing gold from the system. Gold outflows meant shrinking money supply, and shrinking money supply meant deflation. Deflation meant political instability, and the government needed to break convertibility to reflate the system. So they forced surrender at $20.67 an ounce, and overnight revalued it to $35 an ounce, a 41% devaluation overnight. Same ounce, same gold, same chemical compound, different dollar amount. It wasn't about punishing gold owners. It was about saving the monetary system. But now ask yourself, are we on a gold standard today? No. Is the dollar redeemable for gold? No. So under today's system, why would they outlaw gold? We'll come back to that. Now consider silver in 1934. The Silver Purchase Act of 1934 was not confiscation. It required the government to buy silver. It pushed the Treasury to accumulate it, and it monetized silver partially. Why? Political coalition building, of course, Western mining states, monetary expansion without gold outflows. Silver became monetary again temporarily. But here's the interesting question. Could silver flip again from industrial commodity to strategic reserve asset? If solar build-out accelerates, if EV penetration increases, if defense electronics demand spikes, if China restricts out exports further, does the U.S. classify silver as a rare earth? We already treat certain minerals as strategic. If silver is essential to grid infrastructure, military systems, semiconductor fabrication, and renewable energy deployment, at what point does the stockpiling begin? And once the stockpiling begins, does private accumulation become politically uncomfortable? So now let's run the scenarios. What would have to happen for gold ownership to be outlawed again in the U.S.? Well, not inflation. We've had inflation. Not high debt. We have record high debt. Not geopolitical tension, because we've got that too. The threshold would likely require, first, Treasury market instability. Second, loss of confidence in U.S. sovereign debt. Third, a failed bond auction cascade. Fourth, rapid dollar devaluation. And fifth, emergency capital controls. Only then does gold become systematically sensitive. If the government attempted a gold-backed credibility reset, if it repriced official holdings dramatically higher, if it needed to consolidate control over monetary gold, then maybe ownership restrictions would return. But that's extreme, and we'll come to that in a minute too. But silver? Let's examine that now. Silver would require something different. It would require severe industrial shortage, defense prioritization, Strategic Materials Act expansion, export controls, mandatory domestic supply allocation. Silver wouldn't be outlawed as money. It would be restricted as infrastructure, and that's a different logic. Now circle back to March delivery stress. If physical inventories tighten, if industrial demand remains strong, if investment demand spikes simultaneously, if China tightens exports, if geopolitical fragmentation accelerates, do we get a price spike or policy intervention? History shows us governments don't intervene when prices rise. They intervene when systems strain. 1933 was about system strain. 1934 was about monetary coalition politics. So the real question is, will gold or silver be outlawed? That's not the real question. The real question is, what systemic conditions would make policymakers believe they must choose between free ownership and national stability? That's the threshold. Could we see higher taxes on precious metals? We've seen that other places. Could we see stricter reporting? Windfall profit taxes in a crisis? Possible. Outright prohibition? Only if capital controls are in place, banking restrictions exist, dollar credibility is collapsing, or silver becomes formally classified as strategic. And those are high bars, but they're definable. Now ask yourself something uncomfortable. If silver supply is truly tight, if industrial users cannot substitute, if industries are thinner than markets assume, what happens when investment demand collides with industrial necessity? Does price ration supply, or does policy ration supply? And if policy ration supply, who gets priority? Defense, grid, solar, or coin holders? Wild guess for which one it isn't. This is not alarmism. It's structural thinking. Gold was not outlawed in 1933 because it was the monetary anchor. Silver was accumulated in 1934 because it served political and monetary objectives. Today, gold is not a monetary constraint yet. Silver is not a monetary anchor yet. Silver might be becoming industrially strategic, and strategic assets attract policy. So the probability tree, it looks like this. Low stress, nothing changes. Moderate stress, taxes and reporting tighten. Severe monetary crisis, gold policy shifts. Severe industrial shortage, silver policy shifts. The system doesn't move emotionally. It moves when incentives force it to. So the real question for March delivery isn't, will the exchange default? The real question is, if stress reveals tightness, does the world treat silver like a commodity or like a strategic metal? Because once it crosses that line, the rules will change. And history shows us when systems feel threatened, ownership rules are not sacred, they are conditional. In short, build that stack, expect to get heavily taxed, and consider the business costs of taking the win until you can't. Thanks for watching all the way to the end. Follow us tomorrow. And in the meantime, take care of yourselves and each other. As always, build that stack.